Jason, Brad, welcome. Guys, for those that might not know Jason and Brad, they're here to talk about EQIBank and about something that I think the favorite topic of most of you in cryptocurrency, and that is banks. So how are you guys doing?
Great to spend some time with you, Carlos. Looking forward to the discussion.
Doing good. Thank you for having us.
Guys, so I wonder, well, I know a lot of people must be wondering right now, why are people here coming to a crypto podcast to talk about banks? So can you give a short description of what it is that you guys do and how it is that it overlaps with people in the blockchain and crypto community?
Yes, of course. So EQIBank was formed in 2015 with one specific objective, Carlos, to become the world's first global digital bank. So we're a digital bank that's very friendly to the fintech and crypto community. We have a lot of functionality that most banks do not have. And around 20% of our client base is or comprises very well-known giants in the crypto field.
Do say names, please.
I'm afraid as a private bank, I can't reveal the names of our client, but you'll be familiar with most of them.
We're breaking the laws like right from the beginning. We're not waiting for the second half of to do this. So, all right, guys. So one of the very first things that we have to lay down for people that are not familiar with crypto banking and with how this is different from regular banking and all the different procedures is what differentiates a bank that handles crypto with to those that don't, to your regular bank, Santander or whatever?
Yes, of course. So a quick example, we have 6 lines of business. So crypto is actually built into our DNA from the very beginning. So the 6 lines comprise of traditional accounts, US dollar, euro, sterling, Swiss francs, and Canadian, credit cards, wealth management, a whole plethora of lending facilities. And then we become different. We're a licensed custodian, not only for treasuries, bonds, securities, but also crypto. And we also have our own OTC desk, and that's where it starts to become different because you have genuine interoperability between the OTC desk, your credit card, loans from the bank, your traditional national currency accounts, etc. So blending in the needs and requirements of the crypto community was very central to our DNA from the very beginning.
Brad, is there anything that you'd like to add to that?
Yeah, I mean, you asked the question, why is a bank on a crypto podcast? And I think that was a really good question that we didn't directly answer. But if you look at what's happening right now, there is still not a direct way to use the value you create in the crypto ecosystem in your everyday life. Unfortunately, and I'm all a proponent of crypto in, crypto out, but unfortunately today where we're at is that a lot of value is created in crypto, incredible values created, and the people who create it don't have access to it just because you need banking. Whether you like banks, you don't like banks, they work for you, they support you, they don't. At the end of the day, that mechanism allows you to realize the value you created in everyday life. And we thought it was very important, instead of saying we're going to disrupt everything and banks are going to go away. Yes, hopefully, eventually, at some point, everyone will become their own bank. But today, that's not a reality. So instead of, pushing that conversation to 20 years in the future, 30 years in the future, and imagining this utopia, we figured, what can we do practically today to bridge the gap between all the value created in crypto that people can't easily access and a reliable banking solution, that currently doesn't exist on a global scale for crypto businesses, entrepreneurs, investors. And so we wanted to bridge respects the banking regulations and you know, the rules with a DeFi mindset.
Right, guys, is it just me that had Brad freezing a bit during that bit?
No, it was pretty clear on my side.
Okay.
Well, obviously
good.
it's pretty clear for me. So.
Yeah, all good. Then let's just hope it was just on my end and continue. No worries. This will be edited out. So that's very interesting because you mentioned this key component of crypto, this key value or something that has been flaunted around ever since this community started. And that is the be your own bank slogan, isn't it? That's something that has been like the big promise of crypto or one of the big promised disruptions of it. And it somehow hasn't come to crystallize or it has shown light upon the fact that most people don't want to be their own bank, basically. So how do you compensate these two realities, and how do you deal with a community that on one hand aims to do something or promises to do something, and on the other hand, a reality that shows things are just not there, or that most people don't want to even be there?
Well, I think it's an evolutionary track, Carlos. If you look at the size of the crypto industry today, let's say 2 billion, just less than, it's absolutely minuscule in relation to the global investment markets, which are 1.2 quad, and even the banking industry, which is $134 trillion. So the reality is that there'll always be the role of banking institutions, financial services institutions, in order to not only act as a bridge and a gateway, but also to act as a direct path for liquidity as and when the traditional financial institutions get used to crypto, understand crypto, and some of the volatility and security risks are removed. So there's going to be a continued interchange between the two. That isn't to say, however, that the crypto community can't really start to take on more of a proprietary role in its own banking activity. And what you will start to see over the next few years is people opting in and out of the various functions of a bank, depending upon their level of sophistication with crypto. Let's use an example. It may be that one client manages their own wallet, they're very happy with their exchanges, they're coming in and out of crypto, but they need a credit card. That's absolutely easy to provide. In other instances, if you will, family offices, funds, etc., they don't feel comfortable handling their own private keys, and they would prefer a licensed and regulated institution to be that custodian. So it's a way to adapt to all of the needs of the community, not only those, if you will, the crypto purists, but also those that are really interested in the crypto community, but don't really know where to start.
Anything to add there? All good. Then we can think about the way companies, because you guys also cater to companies, right? That's one of the big notions that I think are brought forward by you guys at EQIBank, that the crypto market so far has somehow overlooked companies and has overlooked high net worth individuals. It's very easy for Carlos in Mexico to go play with his $200 account in Binance, and somehow that part works, right? But whenever things start getting, well, whenever people try to get more serious about it, then it becomes a bit of a problem, right? So can we talk a bit about how the process is for companies to jump into crypto?
Yes, absolutely. So obviously the vast majority of banks that are meeting the needs of crypto enthusiasts today are focused on retail clients. We are starting to see an entirely new paradigm of investment funds and vehicles interested in the crypto space. But it's fair to say that most of the big banks are not willing to either assist or provide decent functionality for corporates and funds interested in the crypto market. So back in 2015, EQIBank was created to focus on that need. We meet the needs of high net worth and corporates in 180 countries around the world. And we really act as a guide to these funds, family offices, wealth managers and corporates on how to enter the market, how to protect themselves, give them an indication of some of the products and services that are out there, and really try and provide a white glove service to attract more corporates and more funds to enter into the dynamic market of crypto. But let's use a quick example, Carlos. So there is so much money that is available if we start to move away from the existing crypto community to embrace other financial services entities and products that should be moving into our sector. So let's use derivatives and interest rate swap products. The IRS market interest rate swap product is worth over $500 trillion. So if we start to look at crafting product sets designed to disrupt those industries, you see a dramatic acceleration in the opportunities for the crypto community.
Brad, anything you'd like to add there?
No, I mean, I can only echo Jason's sentiment there. We have to grow our reach and our community to be more inclusive. Obviously, everyone understands and knows the roots of crypto and Bitcoin and how it started and where it started from. But in order to become more accepted and widely used, it has to look outside of the different core groups that have grown it so far, and find ways to include different parties, different groups into the ecosystem in a way that they feel comfortable with. So there's an opportunity here to grow the market cap, and we want to be a part of that solution.
And to meet some of those solutions, the EQI group has moved into DeFi. We are the first bank, as far as we're aware, to power a series of DeFi products, and we believe that is going to be a really exciting addition to the market.
How does that process look like? I cannot imagine my local banker interacting with a DeFi ecosystem, even a simple one such as Uniswap. So how's the process for a bank to jump into DeFi?
We believe that there is a massive opportunity not only to meet the needs of the existing DeFi community, but allow for licensed and regulated institutions to come into this space to do two things: provide that vital bridge and gateway between traditional monies, traditional fixed term deposits, and the massive opportunity ROI on DeFi products, and also meet the needs of the existing DeFi community by being able to interact with existing bank accounts, credit cards, loans, etc. So EQIFI is part of the EQI group of companies, and we offer 4 products: fixed term products, variable rate products, interest rate swap products, and a yield aggregator. So by having the sophistication of a banking team with more than 200 years experience moving into that space, plus the amazing technology team led by Brad, we're able to really disrupt not only traditional lending in the bank environment, but add some, hopefully, material sophistication to the DeFi sector as well. Our belief is that over the next 4 to 5 years, a series of digital banks are going to try and move into the DeFi area to really avail themselves of the returns that are available and those incredible growth market needs.
And Brad, since this is sort of your division, what can you tell us when it comes to the perspective of being sort of the first people to start offering this to the community?
Well, it's an exciting time. I mean, there's always challenges when you're first to do something, because you're actually trailblazing and really, inventing things. So there's always that excitement that goes with the new things you need to come up with. I think we're very well positioned to be successful because we have deep technological development roots in the space and outside, and obviously on the banking side, a very, very strong partner that allows us to do things in a way that other projects can't do. I mean, a lot of the projects in crypto, as you know, start as an idea on a napkin. You know, they come up with a white paper, they raise some money, they build something, and then they realize, oops, I need some licenses and certifications and approval from somewhere. So they start shopping jurisdictions to just exist and you know, can't focus on the main mission because they handicap themselves. We took the exact opposite approach and started from a place where there was all the regulatory environment that supports us, and then built on top of it. So I think again, exciting times, and we really want to get the community support behind this project because it's everyone I talk to is a potential user of one of our products. It may be on the DeFi side, it may be on the banking side of things, but they're very excited, and you know, we wanna deliver, and we wanna increase the crypto market cap. I keep saying that's my dream.
I mean, not to say anything against napkins, we're pro napkin on this on this podcast, but you're absolutely right. Like that's the way most of the 2017 projects started in the crypto world, and that's to a great extent how they're still done today, right? And then you see people flocking into Estonia or into Georgia or into whatever they're able to incorporate and feel like they're away from trouble. But there is never
there's nothing wrong with that. Estonia is a great jurisdiction. They're very forward-looking in their regulations and sandboxes. It's wonderful that different parts of the world, you see these bubbles forming where they embrace technology, they embrace change. What I was trying to get at is, you know, we are in this unique position that we know, you know, we can deliver on what we're building. There are not going to be any challenges once the platform is live on providing services, and that really sets us apart and kind of, you know, puts my mind at ease as EQIFI's CEO that, you know, if we say we're going to deliver a product or a service, I don't have to worry about how are we going to do it, what jurisdiction. That those conversations are already, you know, had, and you know, I have Jason to thank for it, because without his team and ability to do things in a very regulated, compliant way, this project wouldn't be around.
Right, because you can be all, excuse my language, all fuck the police all day long, but in the end of the day, it's just easier to comply from the beginning. And I'm sure investors nowadays are appreciating it a lot more, right? Like they all of a sudden don't want to risk the exposure, or they don't want to risk they just don't want to run the risk of everything bursting into flames just because someone decided not to fill the paperwork. So
no, that's a really good observation, Carlos, because a lot of the type of investors have changed in the past 2-3 years. You know, the crypto investors of 2016-17 are either much more mature and have more to lose now, or it's more of an institutional investor group that came in to support the project. So the appetite for anonymous projects where no one knows who's behind it and what it is doing with unaudited code floating around in smart contracts is hopefully behind us, because that's where a lot of the issues arise, and then it gives the whole community a bad name. You know, you don't have to be a part of a project that has issues just because it gets a lot of press. That bleeds over to the rest of us in the space, and that's not good for us.
You're right there in the trenches, right? You're in the battlefield, seeing institutional investment happening right there. This is a field that's developing as we speak. It's a very new thing, and you see the headlines: Tesla buys Bitcoin, Facebook is rumored to be buying Bitcoin. These and these and these and these institutions are issuing Bitcoin funds or whatever. And I guess I'm not the only one wondering, how does this look like for the rest of the cryptocurrencies out there? How are institutions starting to sort of enter into this market and into crypto, developing a crypto's position in general?
Well, from EQIBank's perspective, we provide OTC facilities for the top 20 cryptocurrencies, same-day clearing, etc., between your various bank accounts and OTC requirements. But at the moment, we are only dealing with the top 20. Outside of that, we're very careful to execute due diligence on any appropriate currency that will touch the bank, and anonymous coins, etc., will remain out of the purview of any sophisticated financial institution. But there is a growing willingness to move beyond that top 20 into innovative offerings that provide security, have appropriate KYC and AML requirements, and genuinely add value to the ecosystem. So what we're going to do is we're going to start to see more banks acknowledge the importance of up-and-coming offerings and product offerings outside of the top 20, because they drive the overall market or meet the needs of corporate investors, funds, and institutions.
And we talk about the top 20 cryptocurrencies, and I'm sure more than one person must be wondering, how's the Doge OTC market looking these days?
Yes, active is the right word.
How are you? How many institutions are out there buying Dogecoin these days?
Well, it's certainly managed to jump onto the map of most wealth managers or institutional players. Difficult to confirm how many are then executing trades, but that amount of public exposure has by and large been positive for wealth managers, institutions, and funds that ordinarily would have been extremely late, perhaps, in examining the opportunity of a coin such as Doge.
And I mean, I don't know I don't pretend to know what Elon Musk is playing these days, right? Like with the Dogecoin and everything. But they just released the reports for Tesla's earnings from the recent sales of Bitcoin, and they effectively managed to rank up quite a big number. And this shows you how these publicly listed companies are essentially fronts for their financial divisions these days, right? Like once things get that big, the financial division starts generating sometimes even more revenue than the main products. So I wonder, how do you see this news? How do you see, what do you feel when you see a company showcasing that Bitcoin is actually a viable path for companies to make revenue and something that people should be exposed to?
From a banking perspective, if banks when banks start to take more cryptocurrency on their balance sheets, it does provide a very unique ability to drive revenue and profitable revenue, which then can be offset or can offset traditional fees and costs. So we're going to start to see more banks, more financial institutions leverage the benefit and the margins of crypto, whether it's lending, borrowing, yield, or investment, in order to provide a more well-rounded product offering for their traditional clients as well. And the more financial services institutions, the more banks that start to provide functionality for crypto is only going to drive the entire market cap in a very positive way. So it's a self-fulfilling prophecy, if you will. The more banks, the more financial institutions, the more corporates that embrace and acknowledge the importance of crypto, the more margins that can be secured as a result of the mass adoption of those underlying asset classes, which provides for a very interesting way to grow the market cap from a couple of billion closer to the market cap of banking assets, which is, as I mentioned, over $130 trillion.
And as you see many more players come into Bitcoin and into crypto, and these are often just players that are highly experienced or institutions that know their stuff coming to crypto. You must be getting quite a lot of skepticism, right? There's no way around that. So what are the convincing points that you have found when it comes to shattering that skepticism or helping people come aboard into this new wave of finance?
Well, one of the major issues is KYC and AML. Addressing those two concerns provides an immediate level of comfort for institutional and fund investors. The truth is that as an asset class, it is extremely volatile, obviously. So most funds that are looking at it at the moment are really looking at it to drive alpha growth and perhaps 3 to 4 to 5% of their overall investment thesis. But that still represents a very large amount of money and can represent huge potential gain from a market cap perspective. So the concerns really are 1, AML, 2, KYC, and 3rd, volatility. But all 3 of those are starting to find a better footprint. They're all starting to find a higher level of integrity. And the more financial institutions that start to embrace crypto, the more that institutional investors will start to feel secure that it is a genuine asset class that can be that can meet a need.
And I guess this would be more of a question for Brad, but what would you... Okay, 2-part question, and one for people that are more experienced in this ecosystem, and second one for those that might just be entering it. But you see that institutions connected to DeFi and just DeFi in general offers a lot higher yields than traditional banking, and that's, I guess, one of your main selling points, and it has to be because it's just part of what drives this revolution. What reaction have you received from your direct ecosystem when it comes to seeing that you're offering this access to these new higher yields? And second, for those that might not be too knowledgeable, how does DeFi manage to offer these higher numbers that are sometimes even 100 times what traditional finance can offer, traditional banks can offer?
Well, I'll touch...
Go ahead, Chase.
I'll touch on the commercial and then Brad will explain some of the technology, Carlos. So you're
Perfect.
Absolutely right. The yields and the returns attributable to DeFi are extraordinarily beyond the traditional range of most banks. And that in itself, Carlos, is the unique opportunity of a bank embracing DeFi. It's not unusual for borrowers to pay anything between 7 to 13 to 14% for overnight rates, money market rates, etc. And it's not unusual to be paying above 5 to 6% on fixed term rates as well. Now, these numbers are completely beyond the traditional scope of financial services products. Let's use a quick example. Today, most Euro accounts are negative interest. So you lodge 100 euros today and next month you have 99 left. When banks start to embrace the attractiveness of the DeFi product set, whether it's money markets or fixed term products, they can see that they can avail themselves of almost double-digit rates. Those numbers can then be used through a series of fixed term products, money market rates for traditional USD and Euro clients. So sophisticated banks are going to be able to provide their normal, as it were, retail clients with rates of 2 to 3 to 4% on their Euro and USD, because the bank takes some exposure in the DeFi community. This is going to revolutionize not only the attractiveness of DeFi, but also the attractiveness of digital banks that are prepared to embrace this new asset class. And let's not forget, Carlos, that the fundamental security behind a DeFi product set, loan to value of 60 to 70% against ETH or BTC, provides enormous security, much more security than a traditional mortgage or an SME loan, etc. So these asset classes can represent a really positive use of tier one capital for any nimble bank.
And so as a quick follow-up on that, Jason, I'm wondering, or someone could be wondering, or you may have faced this question before, why is it that you mentioned that these options are so much more secure than all those traditional products that somehow in the minds of people should be safer?
Wonderful question. Let's use a practical example. You can perhaps provide lending facilities on a house, a traditional mortgage. Now, the mortgage rates are fairly low, but as we saw back in 2008, all it needs is a series of mishaps by global financial institutions to impact the entire housing market, for example. Now, when you need to liquidate a house because perhaps it's been repossessed, it can take you weeks or months or indeed years, Carlos, for a bank to recover its exposure in that asset class. If you compare that with a loan to value of 65 to 70% on BTC, the smart contracts are programmed in such a way to require additional collateral calls or to liquidate a position with incredible efficiency. So the bank's overall exposure to this asset class is a lot more secure than it would be for a commercial loan to a business or perhaps even a residential commercial mortgage. So when banks start to realize that they have lower costs, more security and higher margins by embracing this ecosystem, we're going to see a great deal of activity. And what it means fundamentally is that the average client to a bank will start to avail themselves of 1 to 2 to 3 to 4% in their traditional USD, sterling or euro accounts. And some of those monies will be used as a counterparty for very well licensed, very secure DeFi product sets, really providing a unique way to introduce national currencies as a counterparty to DeFi products, but also massively drive the market cap of the broader crypto community. So that's the way we're going to see mass adoption or mass investment into crypto because of the existing rates and products that can be provided by banks to traditional users.
And yeah, to go back to the original two-part question, and as I said, this part would be more for Brad. And people might think or feel like, okay, something must be wrong here because I'm logging into this platform, let's say Binance, to name one, and it promises me that with 2 clicks I can access a 16% annual yield, something that's 120 times what my bank is offering. So some might wonder, how does DeFi manage to provide these yields that are so much higher than what you would expect from institutions?
Well, I think so. So you have to look at the lifespan of DeFi projects, and you have to look at the lifespan of traditional institutions. You're comparing something that has been in existence for a maximum of 4 years, which is Bancor project, where it all started, to institutions that have been around for thousands of years, hundreds of years. There's a certain level of long-term sustainability there that we're yet to see and experience in the DeFi space. There's several ways that the returns are different from traditional products, but mostly it's the risk profile, and of course, when you do things programmatically, you have less of an overhead. So if you look at the traditional finance and lending side, you have salaries, you have people to pay. Most often you need licenses and registrations and a physical space. All these are added costs to your operations. So any business, if you look at a traditional brick and mortar business, moving even away from banking and finance, there are inherent costs to it that you can eliminate with a decentralized model through technology, through smart contracts. So what some of the really successful DeFi projects have done is they reduce the overhead so much that they can pass that on as an interest or yield to their token holders. Right? If you don't have to have 20 headcount in your analytics department, if you don't have to have another 20 people in your sales department, if you don't have to have multiple offices and have leases on those and furniture and computers, and everything that we take for granted, we don't think about. You walk into a bank branch, you don't really think about, oh, this chair here that I'm going to sit on costs them money. This rent is costing them money. This bulletproof glass costs them money. So if you start adding those operational costs up, they actually amount to considerable sums of money. And so by taking that out of the equation and saying, look, this is a decentralized product, there's no central location or entity, use it, and this is the protocol, these are the smart contracts you're trusting to complete the transaction, you're eliminating a lot of that, which is then passed on to the end user as opposed to going to the expense budget. So that's, I think, the high level, simplest explanation. Then, of course, you can make things complicated by looking into economic models of financial institutions compared to tokenomics in the velocity of which businesses are able to grow, which is why we're really excited about the EQIFI. Because even the best run traditional businesses have a certain trajectory that they can take. I mean, this is like everything is successful, everything is going well, and you grow with a certain trajectory. In the blockchain crypto space, if you are successful and there is demand for your business, one, it's global, and two, it goes really fast. I mean, we've seen billion-dollar companies being created in months in the past 2 years in our space. If you look at even the high-tech space of Facebook and Apple, it took them years to get there, decades, if not. So the acceleration of acquisition and user growth and all those things are consistently faster than the traditional space, which in turn creates an opportunity and a risk, because it's an opportunity where you can provide different products and better yields. It is a risk that if you can't sustain that, then at some point those rates are going to normalize to normal levels, because now you don't have the exponential growth within your smart contract system to sustain them.
That's something that I've heard twice this week, and it creates a bit of dissonance with me. I think you probably have a good answer to this, because here I would think, okay, if let's say project A is offering a certain staking yield of, let's say, 16% annual, and then as people say, like, this technology gets older, these things get more normalized, yields start going down. Couldn't theoretically someone just fork the original protocol and continue to offer these higher yields? And doesn't this market automatically then starts competing up rather than down? Or am I looking at things incorrectly here?
No, that's a really good question. Obviously, you can fork any publicly available code base. I think there are two parallel things happening, though. There's the technological advances and the societal, psychological advances that follow. So just like the people who got into the space in 16, 17 went through one bear cycle, so now they're more careful. They're more mindful of how they're interacting with different crypto projects and products. It's the same thing. You can go and fork Compound if you want and create another Compound. You're not going to reset the journey they had, because they already had it. They pushed something into the market. Market absorbed that product, that company, learned from it, good or bad. I'm using a good example. We can use a bad one too. And as a result, the profile of the investor changed, evolved, matured. So just because you reset the technology does not necessarily mean you're going to reset the minds of people and suddenly they're going to flock to 800% APY or something like that. Also, again, because DeFi is so new, you see a lot of promotional rates that are limited time only that come out of marketing budgets of the projects. So there's sustainable rates that you can offer in these pools and with your products that are self-sustaining. You know, when we're talking about 3, 4, 5%, 8%, 10%, those can be sustainable rates if the mechanism to support them is built properly. If you're talking about 1,600% APY on Sushi Swap across two,
I was just waiting for Sushi Swap to get mentioned.
very, very low capped gems, those are promotional rates. What the mentality there is, let's get users, let's get people excited about the platform. And oftentimes they're communicated very clearly. When you go into those vaults or pools, they say, this is only for 3 months. This is not for 5 years, because paying 1,600% for 5 years would bankrupt pretty much any product in the space right now. But they make sure that they do the user acquisition, they get you familiar with their product, with their token, with the platform, and then in return from the marketing budget, those insane, for the lack of a better term, returns go to the users. But that's not the end product. That's why I was saying in a couple years, when all these good projects mature, you're going to see much more normalized yields and interest rates. However, they are probably going to be, again, much better than a traditional product just because the overhead is not there.
Well, that's a great explanation. And I can highlight from your previous answer as well that blockchain and the crypto ecosystem is predicated upon the fact that you're not trusting people, you're trusting code. So it's basically like trusting a mathematical formula, right? That whatever you replace the value of X, it will do its job just because it's programmed to do so. And there is, of course, the negative side of that, or the possibly risky side of that, which is something that I don't think gets discussed long enough. And I would really like to see what you think of that. Because, okay, you have these formulas, you have these contracts that are programmed, and they're great at doing what they do, but they're in the end programmed by humans, right? And they're sometimes programmed using mathematical models or economical models. What is the chance of these models being wrong and causing a catastrophe down the line? Or again, am I looking at this in the wrong way? Is there a way that these economics, particularly when it comes to offering yields, is there a way these models and contracts can become no longer is feasible to sustain?
Well, I mean, I'll answer because there's a couple answers to that. Can there be human errors in modeling or programming? Absolutely. It happens all the time. That's why, we're doing multiple audits and eliminating those as much as we can. And, projects continue to have bug bounties and things like that. So that's one element. The thing you didn't mention is there's also a nefarious group of people in the space who purposefully mess with the contracts and the programs and the formulas to benefit themselves. So you also have the risk of something perfectly modeled being exploited because you didn't secure it as well as it needs to be. And once there's a lot of value captured on those platforms and formulas, people start attacking them. And I mean, it's a 24/7 effort. If you have millions of dollars in value on your platform, there are people who think, it's a challenge to take that value out of the platform without anyone's knowledge or permission. So you have that element on top of it. Then, of course, the third scenario is you don't always have perfect models. So your question, I mean, the simple answer is yes, there are going to be projects that fail to deliver in the short term, in the midterm, or long term, just because they did not take enough time to do their tokenomics modeling and economic modeling and test it. So one of the things that we spend a lot of time is tokenomics, because we wanted to have a positively growing ecosystem that actually rewards its stakeholders in the long term, not just we do a TGE and everyone cashes out and we move on to the next project. That has been never our goal. But there are projects out there, if you're not careful, that either through ignorance or disregard for long-term value create these systems where the price goes up and then it crashes, and I don't want to say they're designed for that, but that's often happening in the DeFi space, and you just need to be careful about it. I tell people, don't get involved in projects either as an investor or a user if you don't understand the economic model, because probably if it's too complex or you don't understand it, that it's not a good fit for you.
And just to further build on that great analysis, in addition to the pure technological issues, Carlos, it's extremely important that any DeFi product has an enormous amount of pure financial services or banking experience when they're designing the product set. So far in DeFi, we've seen some great technology products, but often they are let down by the fact that they didn't have genuinely highly experienced financial professionals actually modeling out the product set. So using EQIFI as an example, the EQIFI team is bolstered with a banking and financial services team with more than 200 years combined experience in the physical creation and delivery of financial products. So you can imagine the power of that level of experience with an incredible technology team giving rise to a DeFi solution, which is truly unique.
And to touch on the point that Brad mentioned and that you've mentioned too before, Jason, both mentioned the word tokenomics. And that's a very interesting aspect to understand from your point of view. So whichever one of you feels more comfortable answering this, what the aspect of tokenomics, or what do you keep in mind when analyzing these sort of things?
Well, I mean, it depends. There's no one tokenomics model that fits every project and every product and works with all. Obviously, in the traditional world, when you start a business, your stakeholders are your shareholders. So you try to optimize value capture for your shareholders and grow the company and reward those who participated and contributed to that growth. With a token model, you do the same thing. You need to create value capture mechanisms for your token that actually make it useful and make it valuable, hopefully within your ecosystem, but further out if you're planning to be on secondary markets and be traded, which most crypto assets are. You have to keep in mind that, there's going to be economic forces that interact with your ecosystem and your assets and plan for it. Is there a perfect, model? I haven't found one yet, but with a long-term vision and approach, I feel confident that we're able to create a model that grows with the growing use of the platform and rewards the stakeholders.
Jason, you look like you want to add something to that. Should you, or should I jump to the next question?
Brad was absolutely right. The interconnection between the tokenized economy and traditional financial services represents a huge opportunity. If you can dovetail a product set which enables existing financial services institutions to directly benefit from a tokenized product offering, it becomes extremely exciting. It represents an entirely new asset class and something that is inevitably going to attract the attention of fund managers and institutional wealth managers for years to come.
Okay. I would like to ask you as well. We're talking a lot about all the things that you're doing that are different to what we're accustomed to seeing from regular banks. And that is something that stands out from EQIBank, that you're trying to do things differently, that you're trying to bring new ideas and even a new messaging sort of to the space. Oh, the very fact that you're here talking to me proves so, right? Like bank executives don't, at least of the banks that I'm used to see, don't go out to podcasts to talk to people. So one would wonder if this is what the small emerging players in an industry populated by giants are doing these days. What can we expect in the future from mega banks, from huge banks? What do you think is the future for banks?
Well, the problem with banking at the moment is the big bank brands, not only do they have cost-to-income ratios that can often exceed 70 and 80% for the reasons that Brad just discussed, but you're finding that people are extremely unhappy with the banks for several reasons. Too many fees, legacy technology, inefficient monolithic structures, enormous overheads, obsolete pricing models, and really expensive cash handling mechanisms. Branches, the physical handling of cash is very, very expensive. So as digital banks continue to grow and secure a significant market share, they're going to be required to find pockets of activity that actually present profitability. And that's been missing for a lot of digital banks so far. Most digital banks are actually losing money, Carlos. So the ability to move into a market as exciting as DeFi, for example, provides margins and yields that are simply not available in traditional financial service products today. So those that are nimble enough and are not held back by legacy technology, cobalt systems and what have you, are going to actively work with their regulators to see if they can move into this space. The two issues we face there are obviously a knowledge perspective. Most bankers are not familiar, not only with DeFi, but even crypto. And there's a reluctance there. And secondarily, we're seeing that many regulators lack the internal technology skills or knowledge to be able to properly craft and create regulation in this space. And in the absence of that regulatory arbitrage opportunity, big banks are languishing in pretty much a no man's land of being unable to move into this sector because of those overarching issues of legacy technology and regulators that do not have a sufficient grasp of the opportunity around these market sectors. So the small and nimble banks, the ones that are working actively with their regulators, the ones that are willing to adopt to new asset classes, are really going to see enormous growth over the next 2 to 3 years.
And when you say that big banks are not accustomed to crypto, I mean, I guess we can all agree that's a statement that's 99.9% true, right? But of course, I guess in the very bottom, it has a lot to do with the fact that crypto right now is not a good unit of account, or at least not when we're dealing with Bitcoin and Ethereum. Less and less so. It seems like at some points volatility is starting to get under control, but then you see the big spike, and you see how that might be a turnoff for some institutions. So I'm wondering, how do you see the road to crypto started becoming its own unit of account and further down this road?
Well, volatility is both a positive and a negative. If it represents a relatively small percentage of your overall asset investment, the volatility can be very, very attractive. That said, we are starting to see a slightly calmer market. The last couple of weeks have not been indicative of that. But as we start to see more crypto organizations go public, such as Coinbase, etc., you're going to see more institutional investors consider crypto to be a genuine asset class that's worthy of investment. Now, once those institutional monies really start to apply their power and positioning within crypto, you will start to see an evening out of the volatility. Now, that's a year or two away, no question. But that's what the market is looking for. It's looking for exciting asset classes that represent new forms of yield and also longer-term stability. So banks such as ourselves, such as Silvergate, etc., already embrace the crypto community. And the more banks that move into the space, the greater the market cap, the greater the opportunity, and the less volatility we'll see. But one of the major problems that we've just seen recently, Carlos, is that some of the major banks are not only disinterested in accommodating the crypto community, but are actually hostile to it. So I'm sure you saw, or some of the viewers will have seen, HSBC's decision last week not to support customers who want to purchase stock in Coinbase. So let's think about that for a second. That is a global bank that won't support its customers purchasing publicly traded shares. So you still have a massive disconnect between the enormous growth, for example, the DeFi community, and some of the positions taken by global banks. And that provides, in our view, an incredible opportunity for nimble and small digital banks to really gain market share and make a huge difference to this landscape by seizing the opportunity today.
I mean, I'm just about to grab my torch here, but like, is that sort of like an instance of censorship in the end of the day, isn't it? I didn't know about this decision by HSBC, and these kind of things have to reflect negatively on these banks, just as the Decor is mostly based in Cyprus, the company that helps us run this podcast and this team. In Cyprus, you have this instance of Bank of Cyprus, the biggest financial institution of the country, not allowing anyone to interact in any way, shape, or form with any type of institution or company dealing with crypto. One can only wonder then how the path is going to look like when we have more and more of these blockchain alternatives that are so transparent. So that gives food to what I think it's a good question. How do we keep this space more private? How do we maintain privacy when we're dealing with money on the blockchain?
Well, the truth is that if you want genuine access to public markets money, you want genuine access to existing financial services and banks, then you have to have transparency. In our opinion, based on the clients we already have and the massive number in our waiting list, they are very active and desirous of having an open system. They want appropriate KYC. They want appropriate AML because they want to access the huge opportunities of a $134 trillion banking industry and a 1.2 quad investment and derivatives market. So the sophisticated guys want openness and transparency. Of course, there are those that don't, and we respect that and we appreciate that. But the route to growth is always through integrity, through transparency, and through appropriate underlying regulation.
And you were just talking about the Coinbase IPO, and I remember that I wanted to ask this. I think since it's sort of a more DeFi thing, it would be a question for Brad. What are you guys seeing, or what are the prospects on the adoption of new methods of issuing tokenized goods and tokenized financial instruments? For example, Binance has just launched these stock tokens options, and now you're able to purchase stock, I think, in Apple, Tesla, a bunch of companies as tokens.
Yeah, I mean, tokenization. So I think it's a deeper and more complicated question than what do we think of it. I think tokenization is great. Having had the lifespan to actually hold physical paper stocks, then move to digital stocks that a custodian kept on their platform that I could log in and see, to now being able to hold tokenized securities in my own wallet and know that they're in my possession. I think it's an amazing journey for anyone who invests in companies. To see that happen, and how now I went from holding paper to now holding the digital, and in between I lost control of my own assets because I didn't actually have the ultimate keys. So I think it's a very positive progression. But with NFTs and other blockchain applications, I think we're going to see more and more things virtualized. And what I mean by that is, owning a gold coin is great, but then you have to physically secure that gold coin. And just like Jason said, a lot of institutional investors don't always want custody of the things they own. They want to know that they're safe somewhere with a professional custodian, but they don't necessarily want to take custody of it. So I think we're going to see more things virtualized, like diamonds, gold, precious metals, sovereign currencies, and be represented in a way that people can now own them. Like the ultimate key is with them, and I think that's that's a great future for individuals, and probably an adjustment for institutions and governments, where now they have to accept this evolution and find ways to incorporate it. Because fighting decentralization, I think, is it's just not going to work. So it's important to embrace technology and really find ways to work with it instead of rejecting it, like HSBC or these banks that are refusing to even bank people who may have peripheral businesses that don't even touch crypto. I think that approach is going to cost a lot of businesses their bread and butter, just like Kodak not wanting to adopt digital photography. Those institutions are going to see that they're no longer needed because there are others who are going to embrace it and grow with this.
I mean, and this causes sort of an Streisand effect type of thing where you see that every instance of, like you say, the trying to fight decentralization keeps proving and keeps highlighting the need for further decentralization. So I understand that you guys have some big announcements to make today and some things that you're working on as well. So I'll leave you to talk about that, because as I hear, it's a big, exciting announcement coming.
Thanks, Carlos. Well, yes. Well, as you know, EQIBank is one of the most nimble digital banks in the world. Last year, we were voted a top 10 digital bank to watch globally. So we already have coverage, and we're able to provide clients in over 180 countries with a vast number of banking solutions. On top of that is the incredible work that the whole team has done on EQIFI. So for the first time in history, we have four financial services products being launched by a DeFi company that is powered by a bank. So we believe this has the potential to really and truly dynamically change the look and feel of the industry and allow the opportunity to drive enormous market cap.
All right, and since we know that there are more things coming from EQIFI's side of things, what's new, what's coming? Tell me everything.
Well, I mean, I think Jason summed it up really nicely. On top of all the suite of products that EQIBank brings to the platform, we're building a comprehensive set of products on the DeFi side with the fixed term products and fixed rate, variable rate, interest rate swaps, which don't currently exist in a functioning form in the space. And we believe they're going to be of great use to a portion of the DeFi users, as well as our yield aggregator that we're going to launch with. That's going to allow our ecosystem to partner up and access other good projects in the space, because we want to be the gateway to crypto and DeFi for new users and give them an experience that they're already familiar with and feel comfortable with, so that they get to see DeFi and get exposure to it in a way that doesn't confuse them, that doesn't require a lot of technical knowledge or understanding of blockchain. And in success, we do believe that's gonna grow the crypto market cap, and we're excited to take this journey.
And DeFi itself, I mean, I wouldn't be the one shorting DeFi, right? I think it's just something that's going to keep growing and growing for many more years, because it's just the very beginning of a huge change in the way we're doing things. But at the same time, we understand that the DeFi movement right now, it's held together or mostly relying on a very weak link that is the Ethereum blockchain, right? And the huge fees it's currently presenting, and the scalability issue that it's on the works. I mean, the solution has been on the work for a number of years. So do you think DeFi could exist or could continue to exist without Ethereum? Should people be worried about scalability, or what would you tell someone that's worried about that?
I would say don't worry, because couple of things. One, on the EQIFI side, we're platform agnostic. So we're starting with Ethereum, but have plans to proliferate onto 4 more blockchains in the next 6 months. That's on the EQIFI side. But DeFi in general, you would be probably surprised that there are more projects launching outside of Ethereum right now for DeFi than on Ethereum. So there have been a lot of alternatives that have been growing. Binance Smart Chain, Polkadot, Solana, Avalanche. I mean, you name it. There have been alternatives in the DeFi space that attracted enough attention and enough of a community to grow successfully. And we only expect that to even that expansion from just Ethereum is DeFi to no, now you can have DeFi on other platforms and other blockchains. We only expect that to accelerate. So if you ask me where are we going to be in 5 years, I'd say Ethereum is probably going to look a lot different than it does right now. Whether it's sharding or proof of stake or some of the other scaling solutions that are going to be introduced in the next 12 months, maybe 18 if they're delayed. And then Polkadot going live, and several other chains that are either launching or have launched and now they're maturing. I think it's going to be an amazing time to come for all of us, because we're going to stop talking only about Ethereum when we talk about DeFi, but talk about what is the best suited platform for this specific product to launch. And it may be Ethereum still. I'm a big fan of Ethereum, albeit all its challenges and fees, and I don't see it going anywhere. But I don't think anyone who's interested in DeFi or blockchain or any specific product or project has to be worried about everything collapsing because it's not scalable. I think when you look at the news, there's a little bit of additional drama that's not reflective of the technological evolution in the roadmap that's ahead of us. But if you look at purely from what's being done, what's being proposed, I see a bright future.
Right, and since I don't get to talk to many people that are platform agnostic. To be honest, like most people are just not there. They have one preferred one that they like to fight for.
Well, I started with Bitcoin really early and saw its limitations as someone who tried to build on it. Like, try building smart contracts on Bitcoin, and you'll realize you're programming with both hands and feet tied behind your back. And then, obviously Ethereum was a huge step forward, and I was a big proponent and still a big user miner in that space. And I try to go with the evolution. And understand what can be done better, what has been both evolution of existing blockchains and ecosystems, but also new ones that are trying to come and solve a problem. And I think it's so early in the space that we can have 10 more, primary blockchains and it'll still be growing. There wouldn't be anyone who's stepping on each other's toes or trying to get market share. So again, the future is bright. I just feel like there's a little bit of dramatization of news and challenges just because that's journalism.
And if you would look at the news, you would think, over the last 4 or 5 years, you would effectively think that the world was at war, and when it pretty much wasn't for its majority.
Yeah.
And so, but that's a very good point that you touched. Like, I also don't think that blockchains are going to be stepping in each other's toes. I think there are big differences that are obvious for the trained eye, maybe not for those that are not very experienced. But how would you advise people to think of these different alternatives to Ethereum? What differences would you highlight to showcase that they're all effectively different niches at the end of the day?
Well, that's another 2-hour show probably that we can do on that. So I don't want to dive deep into nuances of each one, but I think there are two types of users. There are the consumers, which in that case, I wouldn't even highlight any differences. They should consume the product they understand that makes most sense to them. Who cares if it's on Solana or if it's on Ethereum? No one. They just get the product and, use it, and that's great. For those who are looking to build, I would say do your homework and find the product that suits your needs the best. Just because then the differences really doesn't matter until you start using the blockchain in a meaningful way. So, for your specific project, block heights may be a big challenge, or the speed of the blockchain may be a challenge. The block timing. I mean, it's so specific to each individual project that I would say case by case, find the one that fits the best and build. And, don't feel worried about changing. You can launch a product version 1.0 on one chain and then realize, oh, Ethereum is better, and move to Ethereum, or vice versa. I mean, as long as the product you're building is creating value, solving the problem, then you'll be fine.
I think that's a great answer. So, guys, thank you very much for your time. I think this has been a really entertaining and very educative conversation. Guests are as varied as they come, but I really had a lot of fun talking to you too. So, where can people learn more about EQIBank? Where can they learn more about EQIFI? What would you like them to do if you would like them to do anything after listening to this?
Yes, certainly. Please, you're very welcome to visit our website, www.equibank.com, where clients can onboard digitally to open a variety of banking facilities. And then on our DeFi side, very welcome to visit www.equifi.com to get a great understanding of the 4 products we offer in DeFi and how we're very unique.
And EQIFI is spelled EQIFI.com, because sometimes there's confusion. There's no.
Definitely take a look at what they're doing. Definitely take a look at other materials put out by and about them. When I found out about EQIBank, I really liked in the very end, at the very least, you can see a different approach to a system that's already, how can we say, to an old system that needs renewing. So it's very good to see a fresh perspective on that. Just one last question, and I'll let you two go. Apart from becoming EQIBank users and EQIFI's, apart from using your products, what would you recommend to the average, and we're not giving anyone financial advice, but just in general or as a mindset, what would you recommend to the average crypto investor, to the average member of the crypto community to look at or to keep as good practices when it comes to using DeFi, when it comes to maybe trying to get a bit more out of what they're currently doing anyways?
That's a very good question. And we would recommend the same advice that would apply to any financial services product or utility product. Are they licensed? Are they regulated? Is it an experienced team? Do they have the right backers? Is the product tested and proven? Is it audited? Does it have a reasonable following already and a success story? And if all of those 8 points are positive, it's probably something that's at least worth looking at. If any of those are missing, it's often a red flag.
All right. Brad, anything you'd like to add to that?
No, I'm just going to repeat what Jason said, but simplify it. Always do your homework and do understand the products you use or things you invest in, because, a lot of people get into things they don't understand, and often they end up having a negative experience. And it's very easy to avoid if you take 5 minutes to just look at the things Jason listed, and at least make up your mind after. Don't just follow other people and blindly into projects or tokens and then have a negative experience, because it's not necessary.
And here's something that I would personally add as well, to add to your points. With user experiences getting friendlier and interfaces getting nicer and prettier and cuter, it's easy to think that you understand things that you don't. And it's easy to invest into things that you don't understand. So always self-assess and think if you're really understanding what you're getting into, because it's very easy to get screwed up by just clicking a couple buttons and into something you think you understand. So guys, thanks a lot. Thanks a lot to everyone watching, and I hope to see you two again on the podcast.
Thank you, Carlos. It's been a pleasure.
Thank you for having us, Carlos. Look forward to it.
Bye-bye, everyone.